The market is currently trapped in a tug-of-war between massive macro pressures and some very real geopolitical risk. So here's a framework I'm using to analyze the next 1 to 2 weeks.
Okay, here's the game plan. We're going to start with the big picture, the unseen forces pushing capital around. Then we'll drill down into the key debate happening in the market right now. From there, we'll look at the wild cards, the geopolitical risks that could change everything in a heartbeat. And finally, we'll put it all together into 3 clear scenarios and a couple of specific risk-managed trade ideas. Let's jump in.
First things first, we have to talk about the single biggest economic driver out there. This is the one that's forcing investors to take on risk. This isn't a choice, it's a mandate.
And it all starts with this number, $37.5 trillion. That's the U.S. national debt. Now look, a number that big isn't just a statistic. It's a force of nature. It dictates policy. It completely ties the hands of the government and the central bank.
This massive debt load creates a situation that a lot of analysts are calling a debt trap. It's pretty simple, actually. When the debt gets so big that just paying the interest becomes a problem, the easiest way out politically is to devalue the very currency that the debt is priced in. In other words, sustained inflation goes from being an accident to being the actual policy. And here's the bottom line, the direct consequence for you. This policy forces a massive wealth transfer. It actively punishes anyone holding cash or earning a fixed salary because their buying power just erodes day by day. But at the same time, it rewards people who own real assets, stocks, commodities, things that can reprice higher. The mandate couldn't be clearer. You have to own assets that have pricing power just to financially survive. So this macro reality is forcing money into the market. But that leads to the central question, the big debate that's raging right now. Where exactly should that capital go? Right now, that capital is splitting into 2 very different camps. In one corner, you've got the proven winners, the mega-cap tech giants. The thesis here is simple. Buy quality on any dip. They're already making real money from AI. Their earnings are accelerating, and the argument is that all this regulatory chatter is just noise. But in the other corner, you have small-cap value stocks. The thesis here is that the market rally is finally broadening out. These companies are the ones that benefit the most from easier policy. Think lower rates and a weaker dollar. Plus, they're starting from a place of being historically cheap and massively underowned.
And despite this internal tug-of-war, the overall market has been incredibly resilient. I mean, look at this. The S&P 500 has stayed above its 50-day moving average for 117 straight days. That's not random. That's a clear signal of powerful underlying strength.
Now, what's really interesting is that all the pessimism out there might actually be what's pushing us higher. With so many people worried, it acts as a contrarian indicator. It builds that classic wall of worry that markets absolutely love to climb.
Okay, but this entire, fairly constructive picture could get blown up at any moment. There are several external, unquantifiable risks simmering right now that we have to talk about.
First up, the US-China trade situation. This isn't some vague threat anymore. There is a hard deadline on the table, a potential move to 100% tariffs by November 1st. That's a specific date on the calendar, and it's getting close.
Second, we've got a potential earthquake in the energy markets. There's an unverified claim making the rounds that up to 40% of Russia's oil refinery capacity has been taken offline. Now, if that's even close to true, it's a massive shock to the global supply of gasoline and diesel, and it throws a huge wrench in the inflation story.
And finally, you've got other conflicts just simmering under the surface. There are whispers about potential action in Venezuela, which is an OPEC nation, and of course, tensions in the Middle East are persistently high. Any one of these could escalate without any warning.
All right, before we synthesize all of this into a plan, we have to do the disclaimer. Everything from here on out is for educational purposes only. It's compiled from public sources. It is absolutely not financial advice. Markets involve risk, that includes losing your principal, and options are especially risky and can lead to rapid losses. So, with all that in mind, the macro mandate, the rotation debate, the geopolitical risks, we can finally build a disciplined framework. Let's look at 3 potential scenarios to watch for.
And this table really lays it all out. Our base case, what's most likely, is that the current trend just continues. Controlled inflation, some policy easing, and the rotation into small caps keeps going while geopolitics stays quiet. The key things to watch are the S&P 500 holding its 50-day moving average and small caps continuing to beat tech. Now, the bull case needs a real catalyst, a game changer. Think a major de-escalation like a surprise U.S.-China trade deal, or maybe the Fed signals much faster rate cuts. A rollback of tariffs would be a huge trigger. And then there's the bear case. This is the external shock scenario. The AI bubble bursts, a credit event pops up out of nowhere, or one of those geopolitical flashpoints really blows up. The warning signs would be impossible to miss. A clean break of the 50-day, along with a simultaneous spike in the VIX, the US dollar, and oil.
So let's wrap this up with 2 educational trade structures. Again, these aren't recommendations, just examples of how you might think about expressing a view on that core market debate we've been talking about.
So first up, let's say you're in that buy quality tech camp. Using Google as an example, one way to structure that view is by selling a cash-secured put. The whole idea here is to use fear to your advantage. When some negative headline hits and uncertainty spikes, the implied volatility in options goes up. By selling a put, you collect that rich premium. Your goal is either to just keep the cash if the stock stays above your price, or you get to buy a great company at a discount you were already comfortable with. The main risk, of course, is that you get assigned. You have to be willing and able to actually own the stock at that price.
Okay, now for the other side of the coin, the market rotation thesis. Let's use the small cap ETF, IWM. Here, you might look at something like a call debit spread. This lets you position for that upside rally, but with a very clearly defined risk. It's cheaper than just buying calls, and you know your exact maximum loss right from the start. It's just the premium you paid. But the big risk here is time. This position has an expiration date, and it loses a little bit of value every single day from theta decay. So the move you're betting on has to happen within your time frame. So that's where we stand. We've got this powerful macro force pushing money into assets, we've got a clear rotation happening under the hood, and we have geopolitical time bombs ticking in the background. The final question is, which one of these powerful conflicting forces breaks first?
And one last time, remember, this is not trading advice. Always trade your own plan, and always manage your downside.